Hey everyone, welcome back to the channel. Today we're diving into one of the biggest financial changes coming soon, the 2026 tax reform. Millions of middle-class Americans could see major shifts in how much they owe the IRS once the current tax cuts expire. Whether you're a working parent, homeowner, or small business owner, these changes could impact your take-home pay, deductions, and even your retirement savings. So let's break down exactly what's happening, why it matters, and what you can do right now to prepare before 2026 rolls around. Let's start with a quick refresher. Back in 2017, Congress passed the Tax Cuts and Jobs Act, also known as the TCJA. This law lowered tax rates, nearly doubled the standard deduction, and increased the child tax credit. But there's a catch. Most of those middle-class tax cuts were temporary. They're set to expire at the end of 2025, meaning the rules will automatically revert to pre-2017 levels in January 2026 unless Congress steps in to extend them. That's what we mean when we talk about the 2026 tax reform, or tax cliff. So, what exactly happens when those cuts expire? The biggest change will be a return to higher tax rates for most Americans. For example, the current 12% tax bracket could go back up to 15%, and the 22% bracket could increase to 25%. That might not sound like much, but it could mean hundreds or even thousands more in taxes every year for the average family. Essentially, unless new legislation passes, everyone earning between $50,000 and $200,000 will likely pay more in federal income taxes starting in 2026. Next up, the standard deduction. Right now, most taxpayers benefit from a much larger deduction thanks to the 2017 law. For 2025, it's about $14,600 for individuals and $29,200 for married couples filing jointly. In 2026, that deduction is expected to drop back to around half those amounts. That means fewer people will qualify for tax-free income, and more will have to consider itemizing deductions again. The reduction could significantly affect middle-class households that rely on the standard deduction to simplify their tax filing. Another major change involves personal exemptions. Before the 2017 reform, taxpayers could claim a personal exemption for themselves and each dependent. The TCJA eliminated those exemptions in exchange for a higher standard deduction. But when the current law expires, those exemptions are expected to return. On paper, that sounds good, but because the standard deduction will shrink, many families could still end up paying more overall. The math will vary depending on family size and income, so it's important to run the numbers in advance. Families with children will also feel the effects. The child tax credit, which was increased to $2,000 per child under the TCJA, will drop back to $1,000 per child in 2026. That means parents will lose out on up to $1,000 per kid in direct tax relief. The income thresholds for eligibility may also decrease, meaning fewer middle-income households will qualify for the full credit. For families living paycheck to paycheck, that's a big hit, especially when combined with rising living costs and inflation. Homeowners could also be impacted. The TCJA capped the state and local tax SALT deduction at $10,000, and that cap may change after 2025. If it expires, higher-income homeowners in high-tax states like New York, California, and New Jersey could see some relief, since they'll be able to deduct more of their property and income taxes. However, middle-class homeowners in low-tax states won't benefit much. And with the standard deduction shrinking, fewer people overall may find it worthwhile to itemize their deductions at all. Let's talk about the mortgage interest deduction. Under current rules, you can deduct interest on up to $750,000 of mortgage debt. Before 2017, the limit was $1 million. If the pre-TCJA rules return, that higher cap could come back, potentially helping some homeowners. However, because interest rates are higher now, fewer middle-class Americans are buying homes or itemizing deductions anyway. The benefit here will likely be limited to higher earners or those living in expensive housing markets. One area that might affect workers directly is the income tax bracket indexing. The TCJA changed the inflation formula to a slower measure called chained CPI, which means tax brackets grow more slowly over time. If that remains in place, people could creep into higher brackets faster, a phenomenon called bracket creep. If the old formula returns, inflation adjustments could be slightly larger, helping middle-class earners keep more of their pay. This is a technical but important detail that can influence your effective tax rate year to year. The alternative minimum tax (AMT) could also make a comeback for many households. The 2017 law raised AMT exemption amounts, meaning most middle-class families didn't have to worry about it. But once those higher exemptions expire, more people, especially those with large deductions or high income in certain years, could fall under the AMT again. This means more complex returns and potentially higher tax bills for those who were previously exempt. Small business owners and self-employed individuals will see significant changes too. The 20% qualified business income, QBI deduction, introduced under the TCJA, is scheduled to disappear after 2025. This deduction allowed many freelancers, contractors, and small business owners to exclude up to 20% of their income from taxes. Losing it could mean a noticeable jump in tax liability, especially for middle-income entrepreneurs who depend on that deduction to lower their taxable income. Investors might also notice shifts. The 2017 law didn't change capital gains tax rates, but it did adjust income thresholds for those rates. If the pre-2017 thresholds return, more middle-class investors could find themselves paying higher capital gains taxes on their investments, especially if they've been investing in stocks, mutual funds, or real estate. It's not a dramatic change, but over time, these small adjustments can reduce overall returns and make retirement saving a bit harder. Let's not forget about the estate tax. The TCJA doubled the exemption amount, meaning only very wealthy estates were taxed. But in 2026, that exemption will drop roughly in half, from about $13.6 million per person to around $7 million. While this won't directly affect most middle-class families, it could impact those who have built small businesses, family farms, or real estate portfolios they hope to pass on to their children. Estate planning may become more important for upper-middle-class households. Now, let's talk about what Congress might do. Lawmakers could choose to extend some or all of these cuts, especially those benefiting middle-income families. But that depends on the political landscape after the 2024 and 2025 elections. Some leaders want to make the current cuts permanent, while others argue that extending them would increase the national deficit. The outcome will shape your paycheck, deductions, and financial planning for years to come. So keeping an eye on policy debates in 2025 will be crucial. For now, what can you do to prepare? The best step is to review your current tax situation and talk with a tax professional. Estimate how your taxes might change if rates go up or deductions shrink. You might consider maximizing retirement contributions in 401ks or IRAs, shifting investments, or adjusting withholdings. The goal is to create a flexible plan that can handle higher taxes without throwing your budget off track once 2026 arrives. If you're a homeowner or parent, it's especially important to reevaluate your financial strategy. Think about refinancing before rates or deductions change, or saving extra now to offset potential tax increases. For small business owners, it might make sense to accelerate certain deductions or income into 2025 while rates are lower. Planning ahead, rather than waiting until after the reform hits, can make a big difference in how smoothly you transition. Remember, the 2026 tax reform isn't about punishing the middle class. It's about the expiration of a temporary law. But without action, millions of families could end up paying more, even if their income stays the same. The good news is that you still have time. By staying informed, adjusting your strategy, and keeping an eye on political developments, you can minimize the impact and protect your hard-earned money from unnecessary tax hikes. In conclusion, the 2026 tax changes could reshape the financial landscape for middle-class Americans. Expect higher rates, smaller deductions, and fewer credits unless new laws are passed. Preparation is key. Review your finances, plan with a professional, and make smart moves before the new rules take effect. Don't wait until 2026 to act. Thanks for watching, and if you found this helpful, be sure to like, share, and subscribe for more updates on Social Security, taxes, and personal finance for everyday Americans.